Okay, so now that we have talked about the income statement, let's talk about the second financial statement that we talked about, which is called the balance sheet. So let's talk about that, the balance sheet. Now, this is also referred to as a statement of financial position, just in case you did not know the word balance sheet, which I don't think is the case, but just in case. Okay. Now, we said balance sheet actually reports the assets, liabilities, and equity of a business. So, and we also mentioned that it actually reflects the financial position of the business. And while on the other hand, the income statement shows you the financial performance. So, for balance sheet, there's no like two types of balance sheet. That's not how balance sheets work. So what you have to do is you have to memorize a format of the balance sheet, and that's it. Like, you don't have to worry about which type and what's going on there. Okay. So how does the format look like? First we mentioned the assets, and under assets, now here I will like to give you some guideline. There's a little bit of difference between the format under GAAP and the format of balance sheet under IFRS, which is obviously International Financial Reporting Standards. So as I go along, I'll mention like what the differences are, so you know, like you can memorize the format that is more in line from where you are learning. So let me define some types of assets. So there's two types of categories we have to learn in assets: current assets and non-current assets. So let me define what these are. Now I would say, think of current assets as any asset that can be converted into cash within 1 year. Now, saying any asset that can be converted into cash within 1 year is not a 100% accurate way of defining it, but for now I will use this way. So like as we go along, you'll see why I use this way of doing the current assets. So what are the examples of current assets? Now these examples you really do have to remember, like and it will automatically happen, like, or you can like consciously make an effort to always have this in mind, so that it's to speed up the process of becoming like great in accounting. So examples will be cash. It's already money, you know, I can use it within 1 year. Accounts receivable. Of course, accounts receivable is the money customers owe you. So if the customer owes you money, probably they will pay you within 1 year, right? So it's not like we're not going to give them more than 1 year to pay, in most cases at least. Inventory. Inventory obviously is what we sell. So if I have some stock in my warehouse, inventory in my warehouse, of course I'm going to probably sell it within 1 year, right? Or at least try to do that. Now there's one more expense that I will mention, for which this definition doesn't apply. Something called prepaid expense that we talked about earlier. Prepaid expense is an asset where we pay expense in advance. So now here, of course, we are not converting into cash within 1 year. We're using it within 1 year. So if you want, you can think of current assets as assets that can be used within 1 year. I think that should also be very helpful for you. So why don't we write that definition, right? Any asset that can be used within 1 year. So usually again, cash, you can use it right now. Accounts receivable, you'll receive the money within 1 year. That means it has been used. Inventory, you'll sell it within 1 year. And of course, prepaid expense. Normally, we don't pay for more than 1 year in advance of any expense. So that I will say will be a little bit better definition for you. Now we are going to move on to the current asset. So current asset is any asset, non-current asset. Non-current asset is any asset that has a life of more than 1 year. So that means any asset that usually lasts for more than 1 year is a non-current asset. So what would the examples be? Land, of course. Land has unlimited life, right? It will be there from now to the end of the world. So we have land, we have building. Buildings usually last for like, it depends on what kind of structure it is, but it can last from 80 years to 200 years, right? So buildings obviously last for more than 1 year. Furniture, equipment, machinery, vehicle, and so on. Like these are the common ones I mentioned. Again, it's always good to know the common ones. So the moment you see that in the question, you know this is non-current, right? It makes it a little bit simpler to solve the balance sheet. Okay. Now let's put these into the format of the balance sheet. So first we mention the current assets. If you're following GAAP, if you're following IFRS, first we mention the non-current assets, just to let you know. So I'm going to mention the current assets. So first current asset we will write is cash, then we'll write accounts receivable, then we have inventory, and then prepaid expense. So what I'm trying to do is I'm trying to give you everything I possibly can. I'm telling you these are the 4 examples you'll probably see, right? So you're already good at that. Then if you see something extra, okay, we can manage one little bit of thinking in the question, right? So this will be the total current assets. So let's do that. And now we start our non-current assets, which are also called long-term assets. So here we will have our land, building, and all of these things. So let me just mention. So let's say equipment, land, building, vehicle, furniture, like all of the all of the things we talked about. Now, if you're wondering, does the sequence with which I write matter? Now, yes, it does. But first I will say, worry about memorizing the format, not the sequence. So just to give you a general guideline, under US GAAP or any GAAP, let's say, if we are supposed to mention the assets in terms of their liquidity, means how quickly they can be used up. Cash is the most liquid asset, means I can use it literally right now, right? I can buy something literally right now. Accounts receivable a little bit more illiquid, right? Because it takes some time to receive the money. Inventory is a bit more illiquid, and prepaid expenses a little bit more than that. So it's like we are mentioning them in terms of liquidity. So that's why, like here, I first put equipment, then I put up if I wanted to follow the guideline, I could have put building here, and then a vehicle here, furniture, and like you can follow the liquidity pattern. But for now, I again don't want you to focus on the not so important things. First, focus on the main thing, which is memorizing the format. But if just in case if it's bothering you, like let me write the format in terms of liquidity. Furniture, then we have, let's say, vehicle, building, and then let's say land. And obviously machinery, equipment, whatever comes, it can come before land. But let me just mention that. I guess maybe since we already talked about it, why don't we do that? Rather, let me make it. There we go. Sorry. So yeah, so now it's perfect. Just in case like it was bothering you, like I don't have it in terms of liquidity. But again, don't focus on that. Focus on trying to master the format. Okay. Once we know the total current assets and total non-current assets, we will combine both of them to get the total assets that we have in our business. So now we're done with the assets part of the balance sheet. Now we'll do the part which is called liabilities and equity. Now if you're doing for accounting for a company, you'll write shareholders equity. But even if you write equity, that doesn't really affect it much. It's just a name, right? There you go. So let's say liabilities and shareholders equity. So in this case, first we're going to mention liabilities. If you are in GAAP, if you're using IFRS, first we write equity, then we write liabilities. So assuming again, because we are using the GAAP format, we'll first do the liabilities. Now in the liabilities, we have the, one second, let me correct the spelling. In the liabilities, we have the same concept, current liabilities and non-current liabilities. So let me define current liabilities. I think you might already have an idea. Any liability that needs to be satisfied within 1 year. Okay. So that means any liability that you have to fulfill. Let's say I owe someone money and I have to pay within 2 months. That's a current liability. What are the examples? Like I said, you should always be aware of some examples. Accounts payable, any expense payable that you might have, and unearned revenue can be current and non-current, but for the most part, usually it's a current liability. Then we have the non-current liabilities. These are liabilities that need to be satisfied after 1 year. Means you can take more than 1 year to satisfy these. Any liability that needs to be satisfied after 1 year. Now you might say, what is the example for that? For your level, you just need to know one example of that, which is long-term loan. So the loan you take from a bank, that's the only one you'll probably see in your studies. Okay. So first we mentioned the current liabilities. Oh, sorry, not here. First we mentioned the current liabilities. So under current liabilities, like I said, accounts payable. Then we have any expense payable. I'm saying expense payable, so it can be salaries payable, rent payable, whatever you have in your records. You can have unearned revenue, like we talked about, and these are the three I would say are the most likely that you'll see. So total current liabilities, and now we will do the non-current liabilities, which are also called long-term liabilities. So here we just mentioned long-term loan, and since that's the only one we're talking about, let's just combine them together and do the total liabilities. But of course, if you want to write like total non-current liabilities, no worries, because it doesn't hurt anything, right? You can do that. It just takes one more step. There we go. And now you can do the total liabilities. So this will be the total combining the current and non-current elements into the liability. Okay. Now we have the final part, which is called shareholders' equity. If you're a company, if you're like not a company, if you're just a normal business, let's say you're a sole trader, means you are just one owner, there's no shares, it's not a company, then you can just write owner's equity, right? But in this case, I will show you both ways. For shareholders' equity, which accounts will be there? For owner's equity, which accounts you'll probably see. If it's shareholders' equity, means you're doing accounting for a company, you'll see two accounts. First account called common stock. This is like the capital account, means the money invested by the owners. So for a sole trader, means when there's one owner and you're just a small shop, small business, then it's called capital account. If you're a company, it's called a common stock account, like it refers to the shares value, which is why the owners invest the money in the first place, right? So again, capital, common stock, both mean the same thing, both refer to the money owners invested into the business. The only difference is common stock is the money we received by the owners for the shares, and the capital is just the money that was directly given by the owner without any shares. So conceptually they are similar, but obviously like technically they are different things. Okay. Then the second account you'll see is something called retained earnings. Now we'll talk about retained earnings a little bit more in a while. First, let's complete the total equity. Oh, sorry. Here, yeah. Total equity, or rather, I should say shareholders' equity. And now we can combine the liabilities and equity to see if they match the total assets. If they do, that means you have solved it correctly. The accounting equation is holding true. Do you remember the accounting equation? Assets are always equal to liabilities plus equity. So now we'll combine the liabilities and shareholders' equity value to see if it matches the asset. If it does, you have done everything correctly. You don't have anything to worry about. Now you might be wondering, like, how do I do the retained earnings? Don't worry about that. That is in our upcoming video on the statement of changes in equity, which is another financial statement.